Most people treat their retirement account like a savings bin, but in reality, it is a high-stakes bet against the United States government. If you pick the wrong account today, you are not just choosing a tax preference, you are essentially handing a blank check to the IRS that they get to fill out 30 years from now. I have spent a lot of time looking at spreadsheets, and I have noticed something frustrating. Most of the advice you hear about Roth versus traditional accounts is technically correct, but practically useless because it focuses on the stock market. I am going to tell you something right now that might sound like heresy in the world of finance. The market does not matter in this decision. Whether the S&P 500 goes up 5% or 15% is completely irrelevant to whether you should choose a Roth or a traditional 401k. There is only one variable that actually dictates your success or failure, and it is the one thing almost every investor forgets to calculate. It is a bet on your future self, your future income, and the future mood of Congress. If you get this wrong, you could be looking at a hidden tax bill that eats 40% of your life savings. Before we dive into the math that the banks do not usually show you, I want to make sure you are getting the best return on your time. If you find yourself geeking out over tax arbitrage and portfolio efficiency, you should probably be part of the optimizers. That is our channel membership community. You can click the join button below to get priority replies on your comments and those custom sketch badges that show you are part of the inner circle. We try to keep the signal-to-noise ratio high here, and that community is where the deep dive conversations happen. Today, we are moving past the surface-level blog posts. We are going to look at why compound interest is actually a secondary factor, and why your tax bracket trajectory is the only thing that moves the needle. We are going to build a mental flowchart together that helps you decide exactly where your next dollar should go. No fluff, no vague suggestions, just the hard logic of tax arbitrage. Let's start by debunking the biggest myth in retirement planning. You have heard it 1,000 times. Someone tells you to choose a Roth 401k because all that compounding growth is tax-free. They say, if your $10,000 grows into $100,000, you want that growth to be shielded from the IRS. It sounds logical, right? It feels like you are getting a massive win by protecting the gains. But mathematically, that is an illusion. I call this the compound interest trap. It is based on a misunderstanding of how multiplication works. If the tax rate is the same when you put the money in and when you take the money out, the Roth and the traditional accounts will leave you with the exact same amount of spendable cash down to the penny. It does not matter if the money doubles, triples, or grows tenfold. This is thanks to the commutative property of multiplication. In a Roth, you pay the tax up front, then let the remainder grow. In a traditional, you let the full amount grow, then pay the tax at the end. Because the order of multiplication does not change the product, the end result is identical. The growth is not what makes one better than the other. The growth is a passenger. The tax rate is the driver. Let us actually run those numbers so you can see the proof. Imagine you have $10,000 of gross income to invest, and you are in a 20% tax bracket. In a Roth scenario, the IRS takes their $2,000 immediately. You have $8,000 left. If the market doubles your money, that $8,000 becomes $16,000. You own it all. Now look at the traditional account. You put the full $10,000 in because you get that upfront tax break. The market doubles it, so your account balance shows $20,000. You feel richer, right? But wait until you go to spend it. The IRS shows up and takes their 20% cut of that $20,000. That is $4,000 gone. What are you left with? $16,000. It is the exact same result. I have seen people argue over this for hours on forums, but the math is indifferent to your feelings. Vanguard and Fidelity have both published research confirming this. The market return applies proportionally to the money in the account and the money you owe the government. Therefore, the market performance is a wash. If you want to win this game, you have to stop looking at the stock charts and start looking at your tax returns. If market returns do not matter, what does? It is a concept called tax arbitrage. In the finance world, arbitrage is just a fancy way of saying you are buying something in a cheap market and selling it in an expensive one. With a 401k, the asset you are trading is your own income. When you use a traditional 401k, you are making a bet that your tax bracket today is expensive and your tax bracket in the future will be cheap. You are essentially shorting your current tax rate. When you use a Roth, you are doing the opposite. You are betting that your tax rate today is the cheapest it will ever be, and you want to lock that in before the price of being a taxpayer goes up. This is where most people get tripped up, because they do not understand the difference between their marginal tax rate today and their effective tax rate in retirement. We live in a progressive tax system. That means not every dollar you earn is taxed at the same rate. Your first few $1,000s are taxed at 0, then 10%, then 12%, and so on. When you contribute to a 401k, you are saving money at your highest or marginal rate. But when you retire, you are not just pulling money from the top. You are filling up those lower brackets from the bottom up. Think of your tax brackets like a series of literal buckets. When you are working, your salary fills up the 0% bucket, the 10% bucket, and the 12% bucket. By the time you get to your 401k contribution, you are usually pouring money into a bucket that charges you 22 or 24%. When you put that money into a traditional 401k, you are essentially telling the IRS, "I will pay you later." When retirement arrives, you no longer have a salary. Your buckets are empty. The money you pull out of your 401k starts filling those buckets from the bottom. The first chunk of money is covered by the standard deduction, roughly $14,000 for a single person, meaning it is taxed at 0%. The next chunk is taxed at only 10%. Even if you were in the 24% bracket during your career, your effective tax rate in retirement might only be 12 or 15% because you are utilizing those bottom buckets. This is why for the vast majority of Americans, the traditional 401k is the mathematical winner. You save at 24% today to pay 12% tomorrow. That 12% difference is pure profit. But, and this is a huge but, there are scenarios where this logic completely flips. If you think a 12% tax win sounds good, you need to realize that the government has a few traps hidden in the fine print that can turn a traditional 401k into a total liability. We are talking about things like the tax torpedo and IRMA surcharges. If you have been a super saver and you are sitting on a massive 401k balance, the IRS eventually stops being patient. They will actually force you to take money out whether you want to or not. This can spike your income so high that it triggers extra taxes on your Social Security and even increases your healthcare costs. Most people stop their analysis at the tax bracket, but that is where they lose the game. We are about to walk through a flowchart to see if you are one of the people who should actually be avoiding the traditional 401k despite the upfront tax break. If you are a high earner or a young professional, the next 3 minutes are going to be the most expensive minutes of your year if you look away. Let us start the flowchart. Node number 1 is your current tax bracket. If you are in the 10% or 12% bracket right now, which for a single person in 2024 is anything under roughly $47,000, your decision is easy. Go Roth. There is almost no scenario where your tax rate in the future will be significantly lower than 10 or 12%. Historically speaking, we are living in a period of incredibly low tax rates. You are essentially getting a clearance sale on taxes. Lock it in. However, if you are in the 22% bracket or higher, the decision gets complicated. Now you have to look at node number 2, your career trajectory. Are you a medical resident making $60,000 today, but expecting to make $400,000 in 5 years? Are you a young law associate? If your income is a rocket ship, the Roth is your best friend. Even if you are paying 22% today, you are avoiding the 35 or 37% bracket you will likely be in later. You want to pay the tax while you are relatively poor so you can be wealthy later without the IRS taking a 40% cut of your success. But if your income is stable or you are in your peak earning years, you should probably lean toward the traditional 401k. The second node is something people almost never talk about: geographic arbitrage. We focus so much on federal taxes that we forget about the state. Imagine you are working in a high-tax state like California or New York. Your marginal state tax rate could be another 9 or 10%. If you contribute to a traditional 401k today, you are avoiding that 10% state tax. Now, imagine you plan to retire in a state with no income tax, like Florida, Texas, or Nevada. By using a traditional 401k, you have successfully avoided a 10% tax that you will never have to pay. That is an immediate 10% return on your money before you even look at the stock market. On the flip side, if you are currently in a no-tax state like Washington, but you plan to retire in a high-tax state to be near family, the Roth looks much more attractive. You are paying 0% state tax now to avoid paying 10% later. This is why I say personal finance is personal. Your 401k choice is actually a prediction of where you will be living 30 years from now. If you do not have a moving plan, you are just guessing. And guessing with your retirement fund is a dangerous game. Node 3 is the one that keeps me up at night: legislative risk. We like to pretend that tax brackets are fixed, but they are actually written in sand. Right now, we are living under the Tax Cuts and Jobs Act of 2017. These rates are historically low, but here is the catch: they are legally scheduled to expire at the end of 2025. Unless Congress acts, the 22% bracket becomes 25%. The 24% bracket becomes 28%. And that is just the scheduled change. When you look at the $34 trillion in national debt, it does not take a math genius to realize that taxes probably have nowhere to go but up in the long run. If you believe that the government will eventually be forced to raise taxes to pay its bills, the Roth 401k is essentially a legislative insurance policy. By paying your taxes now, you are locking in today's rates and protecting yourself from whatever a future Congress decides to do. If you think the current tax environment is a bargain, then the Roth is how you buy that bargain and keep it forever. However, if you are currently in the 32 or 35% bracket, you are already paying a premium. For you, the upfront deduction of a traditional account might be too valuable to pass up, even with the risk of future hikes. We have covered the brackets, the geography, and the laws. But there is a secret variable that can ruin even the best tax plan. It is something called the Required Minimum Distribution, or RMD. I have seen savers do everything right. They maximize their traditional 401k for 30 years, they live frugally, and they build a $3 million nest egg. Then they hit age 73, and the IRS suddenly becomes a very aggressive business partner. They will force you to take out 6 figures a year, which can push you into a massive tax bracket and ruin your plan to stay in the low-income tiers. In a minute, I am going to show you how the Roth 401k actually gives you total control over this. But first, we need to talk about the tax torpedo. This is the moment where taking just $1 extra out of your traditional account can cost you 50 cents in lost benefits. If you are not careful, the government will use your 401k against your Social Security. The tax torpedo is one of the most brutal parts of the US tax code for retirees. Most people do not realize that their Social Security benefits can be taxed. Whether or not they are taxed depends on your combined income. If you pull money out of a traditional 401k, that counts as income. If that income crosses a certain threshold, which is surprisingly low, around $34,000 for individuals, then up to 85% of your Social Security becomes taxable. This creates a localized marginal tax rate that is terrifying. For every dollar you take out of your 401k, you might be paying your normal tax rate plus triggered taxes on 85 cents of your Social Security. Some analysts at Morningstar have pointed out that this can lead to an effective tax rate of 40 or 50% for middle-income retirees. This is where the Roth 401k shines like a beacon. Roth withdrawals are completely invisible to the IRS when they calculate whether your Social Security is taxable. By having a Roth bucket, you can pull out $50,000 to buy a new car or renovate your kitchen, and as far as the Social Security tax calculation is concerned, you earned $0. It is the ultimate shield against the torpedo. There is one more trap we have to discuss, and it is a somber one: the widow or widower penalty. Most couples plan their retirement based on the married filing jointly tax brackets. These brackets are wide and generous, but statistically, one spouse will outlive the other. When that happens, the survivor eventually has to start filing as a single taxpayer. Single tax brackets are roughly half as wide. If the surviving spouse inherits a large traditional 401k and is forced to take those required minimum distributions we talked about, they are now pushing that same amount of income through a much narrower funnel. They could suddenly find themselves in the 32% bracket instead of the 22% bracket, all while dealing with the loss of a partner. This is a massive tax hike that hits at the worst possible time. A Roth 401k protects the surviving spouse. Because those withdrawals are tax-free, it does not matter how narrow the single tax brackets are. The money comes out without a toll. Ed Slott, one of the top IRA experts in the country, often says that the Roth is the best gift you can leave a spouse, because it removes the future tax liability that could otherwise consume their inheritance. So, after all of this, what is the actual protocol? What do you do if you cannot predict the future? The answer is tax diversification. You should never put all your eggs in one basket, and you should never put all your money in one tax treatment. I recommend that almost everyone strives to enter retirement with 3 distinct buckets of money. Bucket 1 is your tax-deferred bucket, that is, your traditional 401k or IRA. You want enough in here to fill up the 0, 10, and 12% brackets in retirement. If you do not have any traditional money, you are actually wasting those cheap tax brackets. Bucket 2 is your tax-free bucket, the Roth 401k and Roth IRA. This is your flexibility money. You use this to stay under the Social Security tax torpedo and to avoid RMDs. Bucket 3 is your taxable brokerage account, which is subject to capital gains rates. By having money in both traditional and Roth accounts, you give yourself the power to manufacture your own tax bracket. If you need $80,000 to live on, you take $40,000 from traditional to fill the low brackets, and you take the other $40,000 from Roth so you do not spill over into the high brackets. This is how the wealthy stay wealthy. Let us see how this diversification works in a real-world retirement scenario. Imagine you are retired, and you need $100,000 this year. If you take all $100,000 from a traditional 401k, a good chunk of that money is going to be taxed at 22%. You will also likely trigger the Social Security tax torpedo, and maybe even see an increase in your Medicare premiums. Your actual spendable cash might only be $75,000 after all the hidden costs. But if you have diversified, you can play the game differently. You take $60,000 from your traditional account. This keeps your income low enough that your Social Security remains mostly untaxed and you stay in the lower tax brackets. Then, you pull the remaining $40,000 from your Roth 401k. That $40,000 is completely invisible. You get your full $100,000 lifestyle, but your tax bill looks like you only earned $60,000. This is the holy grail of financial planning. You are using the government's own rules to minimize their cut. JP Morgan's research shows that this kind of withdrawal sequencing can add years to the life of your portfolio. It is not about how much you make, it is about how much you keep. And you keep more when you have the right mix of buckets. This is the strategy I use, and it is the one that provides the most peace of mind. At the end of the day, the Roth versus traditional debate is not a market decision. It is a life decision. You are making a bet on your future income, your future location, and the future of the country. If you are young and just starting out, bet on yourself and go Roth. If you are a high earner in a high-tax state, take the deduction now and go traditional. And if you are somewhere in the middle, hedge your bets with tax diversification. I want to hear from you in the comments. I consider this a peer review process. Are you Team Roth or Team Traditional? And more importantly, what is the one variable in your life that made you choose? I will be down there responding to the optimizers first, so if you want to join that group, click the button below. This channel only works because we share the data and the logic that the big banks usually keep for their private clients. Remember, the goal isn't just to retire. The goal is to retire with the freedom to spend your own money without asking the IRS for permission. I'm Tom, and this is Tom Talks Money. I'll see you in the next one.